This is a recording for Section 8.2 Income Tax. Income tax is a percentage of your income collected by the government to fund its services and programs. The average American pays over $10,000 per year in income tax. The federal government collects income tax, and most, but not all state governments do as well. So some states like Illinois have a state income tax, but other states do not, like, for example, Washington State. Income tax revenues pay for our national defense, fire and police protection, road construction, schools, libraries, and parks. So we are going to look at how income tax is computed. If you ever do your own taxes, this should come in handy. So we have something called the gross income, which is the total income for the year. This is wages, tips, interest or dividends from investments, unemployment compensation, profits from a business, rental income, game show winnings, etc. The adjusted gross income is the gross income minus certain allowable amounts called adjustments. These adjustments can be untaxed portions of the gross income, such as tax-deferred savings plans, interest paid on student loans and alimony payments. And I know that I have done, the medical, where you are allowed to set aside a certain amount towards medical bills tax-free. So note, in a traditional tax-deferred retirement plan, you get to deduct the full amount of your contribution from your gross income. However, you pay taxes on the money later when you withdraw it at retirement. So there's actually a couple different retirement plans. One, you pay taxes immediately, and one, you pay taxes once you take the money at retirement. But a traditional tax-deferred retirement plan is when you pay taxes when you actually get the money when you retire. So an exemption, you are entitled to certain exemptions and deductions subtracted from your adjusted gross income before calculating your taxes. An exemption is a fixed amount on your return for each person supported by your income, right? A standard deduction is a lump sum amount that you can subtract from your adjusted gross income. The IRS sets this amount, right? It's a fixed amount. Most young people use a standard deduction, right? You can deduct a lot of things, such as, contributions to charities, taxes that you pay on your house, that type of thing. So if you add all that up and it's more than the standard deduction, you won't use a standard deduction, right? But most young people don't have, a house or can donate to charity, that type of thing. So they usually use a standard deduction. Itemized deductions are deductions you list separately if you have incurred a large number of deductible expenses. And this is what I was just mentioning before: home mortgages, state income tax, property taxes, charitable contributions, large medical expenses that are over 7.5 of the adjusted gross income. So you can only put those in your itemized deduction if your medical expenses are over 7.5% of the adjusted gross income. Taxpayers should choose between the greater of a standardized deduction or a itemized deduction. That's what I mentioned earlier. So most people that have a lot of expenses will probably use the itemized deduction, otherwise a standard deduction. Tax credits are sums of money that reduce the income tax owed. So at the end, you would subtract off the tax credits from your tax bill. Donating a kidney, buying an energy efficient dishwasher, and other activities the government wants to encourage, they might offer you some tax credit to do that. So how we calculate the income tax is first you determine your adjusted gross income. So it's just your gross income minus the adjustments. And then when you determine your taxable income, you take your adjusted gross income, so your gross income minus your deductions or your adjustments, and then you subtract off your exemptions and deductions. Okay. So then you can determine the income tax by taking this tax computation that we will talk about in a minute and subtract off the tax credits, right? But the first thing you have to do is figure out what your taxable income is by subtracting off the adjustments, the exemptions, and deductions. Example, a single man earned wages of $46,500, received $18.50 in interest from a savings account, received $15,000 in winnings on a TV game show, and contributed $2,300 to a tax-deferred savings plan. He is entitled to a personal exemption of $3,800, right, which was a fixed amount determined by the IRS, and a standard deduction of $59.50. The interest on his home mortgage was $6,500. He paid $2,100 in property taxes and $1,855 in state taxes, and he contributed $3,000 to charity. Determine the man's gross income. All right. So remember that not only do we have to take into consideration for his income, not his adjusted gross income, just his gross income, you have to take into consideration how much he earned, but also how much he earned in interest. So he received $1,850 in interest and $15,000 winnings in a game show. And contributed, okay, so that's what he took in, right? That's income. He took in the rest, you know, he contributed to a tax-deferred savings plan. That's something that we would actually subtract off, a personal exemption, all the other stuff we would subtract off, right? But this is what he's actually gained. So we can go ahead and add that up. 46,500 plus 1,850 plus 15,000. So his gross income is 63,350. Okay, that's what he took in. So I'm unfortunately not going to be able to go back to this slide, so I'll just have to refer to it in my notes, and you will as well, to go on to the next part. Determine the man's adjusted gross income. So remember that the adjusted gross income is your gross income minus any adjustments. All right, so we already calculated how much money he brought in altogether. The gross income from Part A was $63,350. And then we need to subtract off any adjustments. Well, he contributed $2,300 to a tax-deferred savings plan. And those are the only adjustments. These, remember, the adjustments are anything that's not going to be taxed, right? So we take the $63,350 and subtract the $2,300 off the adjustment, which is $61,050. The other numbers are in there are the personal exemption and the deductions, which is how we calculate the man's taxable income. Okay, the man's taxable income, remember taxable income, it's from a previous slide, is the adjusted gross income minus the exemptions and deductions. You can either subtract off both or add them together and then subtract them off, whatever you want. Deductions. You're going to subtract off those. So the adjusted gross income we just calculated in Part B was $61,050. And then if we refer back to the slide, it gives us, he's entitled to a personal exemption of $3,800, and a standard deduction of $58.50. But then below it talks about the other possible deductions. So we do have a personal exemption, right? That's from the fixed. So we can subtract that off. But for the deductions, we need to decide if we do a standard, which is $59.50, or do we want to do an itemized, right? Do our itemized deductions add up to be more than the standard? We want to subtract off as much as we can so that our taxable income is as low as possible. So the interest, remember the itemized deductions are the interest paid on the home, the property taxes, things to charity, etc. The interest on his home was $6,500. Property taxes was $2,100. You can look back at the previous slide. State taxes $1,855 and $3,000 towards charity. This, I mean, even the $6,500, the mortgage was way more than the interest on the mortgage was way more than the standard deduction. So this is way more than standard deduction. If it's way more than the standard deduction, right, then we want to use the itemized deduction. So the itemized deduction, we're going to subtract all that off if we add those together. So if we add those together, 6,500 plus 2,100 plus 1,855 plus 3,000. The itemized deduction is 13,455, right? So that's what we're going to want to subtract off here, right? So our fixed exemption, right, is 3,800, and then we want to use the itemized deduction because it's greater than the standard deduction. We always need to compare those two. And we subtract, take 61,050 minus the exemptions and the deduction, and the taxable income is $43,795. You subtract those two amounts. So now we are going to look at how, once we have the taxable income, how we figure out how much we are paying towards our income taxes.